The Dow and the S&P 500 snapping a 6-session winning streak yesterday. The Dow was down better than 250 points. Joining us right now to weigh in is OppenheimerFunds Chief Investment Officer Krishna Memani. Krishna, good to see you.
Yeah, good to see you.
What are you expecting this year?
So we still expect equities to do reasonably well. The market had run up a lot. It kind of recalibrated itself. But the overall economy on a global basis is doing quite well. Earnings are good. Rates are still very low. They may be higher than where they were, but they're still very low. Yeah. That's still a good environment for equities to do well.
So you like stocks. I mean, you said earlier, we look at S&P 500 earnings, Mike, talking about 20% gains.
Yes.
For 2018 in the S&P 500.
You have huge earnings growth, which I think is the underpinning to the market. But I think when people talk about volatility, Krishna, you know, we talked for years about needing to spur GDP growth, needing better growth in this economy in the U.S. Well, now we're getting it. But with that, almost by definition, comes some sort of inflationary pressures. Now, I don't know how much they are right now. So when you see volatility this year versus last year, everything was going in one direction. Everybody needed to throw some heat on the fire to get the economy going. Well, now we have the economy going, and all of a sudden you're seeing some people saying, well, inflation's creeping up, so pull out of the market. As an investor at home, how do you look at that, and do you stay long the market, or do you rebalance? What's the
So our recommendation would be still to stay long the market. Inflationary pressures have picked up some, but inflation is still quite low, and therefore the likelihood that rates rise in a meaningful way, I don't think that's in the cards. As long as that is the case, as he said, earnings are good, growth momentum is good, tax cuts, the deficit spending related to the budget deal, all of that will get growth higher rather than lower, and inflation remaining relatively stable in our view.
But, yeah, so you have yields. Go ahead, Dink.
No, but it raises the supply of debt that will be issued by the Treasury at a time that kind of unnatural demand created by the Federal Reserve and the expansion of the balance sheet since the financial crisis, that's disappearing more and more as we move into the new year. So there is an unknown, almost an unanswerable question about how much higher Treasury yields could go here.
Absolutely. So Treasuries have gone up in yield because of that pressure. Having said that, I think if U.S. growth is substantially higher than what the trend rate is, a lot of that will leak overseas. Trade deficit would widen, and that in turn will finance a lot of the treasuries that need to be sold. So I think that's the thing to watch. If that is not the case, that is, the trade deficit doesn't widen, or the foreign central banks are not buying treasury debt, then overall dollar would be far more volatile, and that would be a sign of trouble.
I think we're tiptoeing around a big and important issue. Is that one of the reasons why everybody's talking about buy stocks, and this is a good time to put money to work, is because there's an underlying bid in the marketplace, and that's companies themselves. We saw actually Home Depot come out with earnings yesterday. They talked about fiscal 2017, $8 billion in buybacks. How should investors look at that, and when they're coming into how to deploy capital in the market?
And you said that first a couple of weeks ago.
Yeah. I
said, saying, look, as soon as this earnings period we get beyond the earnings period, companies are going to be in the market buying their stocks.
Yeah, they were blacked out from doing it. So when the volatility came, if you're a CFO, you're like, great, I can buy my stock at the same price it was a couple months ago.
Doesn't this boost the markets near term?
Oh, absolutely. Buybacks have been one of the biggest supports in the market for quite some time. Effectively, the more money has come into the stock market in a perverse way through buybacks than through people buying actually equity funds. So clearly that has been a big support. The tax legislation effectively gives corporations more money to do more buybacks. And I think they're likely to do more of that than capital investment. So that's something that we need to think about as well.
Well, we need to see capital investment. They've been sitting on cash for so long, unwilling to put any money to work. I think we're going to see some capital investment.
So the economy is doing well. So we will see some capital investment. Whether a lot of the tax cut gets invested or not, I think, is an open question still.
All right. So what do you tell clients now?
We tell clients, don't get too bogged down with the short span of volatility. Stick to buying equities.
Like what? What equities do you like?
We like emerging market equities the best because the valuations there are probably the best, and growth prospects are quite good, and they are less China dependent. So I think that's a good circumstance.
Yeah, because this is the first time in a long time that we're seeing synchronized global growth.
Right, absolutely. Do you underweight bonds, though?
Well, no. I think, again, bonds have a role in your portfolio. And for individual investors, especially, if the markets don't work out the way we expect them, you need a part of the portfolio that acts as a ballast. And bonds are the only thing that can do that.
I tell you, there's a lot of commentary about emerging markets right now. That's all of our guests keep saying that's where the valuation opportunity is.
Well, the dollar's been weaker. Commodities have gone up, which has helped them. So there's a couple things going on in that regard.
I'll take the S&P versus emerging markets.
You will?
Totally.
Well, you've been a winner for the last 5 years.
Thank
Whether
you.
that would be the case for the next 5 is an open question.
Krishna, great insights from you. Thank you so much.
Thank you.
Krishna Memani, Oppenheimer Funds there.